Inducements are basically traps for retail traders where smart money entices market participants to enter for trades and transact at certain levels. In this way, smart money is able to generate a large amount of liquidity in order to fuel their large positions. They basically entice retail traders by using obvious chart patterns like double top and double bottom or support and resistance levels. Basically all these retail trading concepts, baiting them into entering the trade early. For example, when a retail trader see a double bottom chart pattern just like this form at a support level, they are going to enter for a buy, thinking that price will go up. And as a result, they will most likely be placing the stop loss below the support level or below the double bottom just like this. And when this happens, this actually generates liquidity. Because if the retail traders who entered for a buy right here get stopped out, guess what? They have to sell the position. On the other hand, this double bottom chart pattern also induces the retail traders who might be bearish and they want to enter for a sell when price actually break out of this support level right here. In this case, they will most likely be placing a sell stop order below the support level or below the double bottom, once again generating liquidity below these lows right here. Now, once all the retail noobs have been induced to enter for their buy orders and their sell stop orders, smart money will then manipulate price by pushing it down to sweep the available liquidity below these lows, and when this happens, this will generate enough liquidity to fuel their large buy orders, and this causes price to skyrocket to the upside. This is exactly why you keep on getting stopped out only to see price go in your way. It's simply because smart money is just getting some liquidity from you. Now let's look at other types of inducements. So in this bearish scenario right here, we have price pulling back to this supply zone that we have right here. And the minute price actually mitigate this supply zone, it formed a double top. Once again, when retail traders see this double top chart pattern, they're gonna think that, you know what, I'm gonna enter for a sell right here and place my stop loss above this double top. Only for price to later go on there, sweep the available liquidity above this double top before going back down. Right, it's pretty much the same concept right here. On the other hand, there will also be retail traders who want to enter for a buy after price actually break out of this resistance level or this double top. In that case, they'll be placing their buy stop orders right here, only for smart money to manipulate price up there and psych them out of their position by causing price to reverse and head in the other direction after grabbing liquidity. So yeah, this is exactly why chart patterns don't work that well, right? So if you're still trading chart patterns, it's time to stop, alright? On the other hand, right here, we also got a strong low and strong high example. Now, the other type of inducements is also created when there is a strong low or strong high. In this case, we got price pulling back to the last swing low, right? And what happened was that the internal structure turned bearish to facilitate that pullback. So we could expect the internal structure to be bearish. And when we see price breaking past the last internal lower high, that tells us that there is a market shift, there is a shift in structure, and price is gonna head up, right? Wrong. Because what can potentially happen is that price could just go up there, sweep the available liquidity above this swing high right there before coming down there, even further sweeping the available liquidity below this swing low as well, right? So a lot of retail traders, they will most likely enter for a buy after this strong low is formed, but then later price come down and sweep more liquidity before actually going to the upside. Or in this bearish scenario right here, where a strong high is formed after price actually break past that strong internal higher low, right? When this happens, remember there is available liquidity above this swing high. Once again, because all the retail traders who enter for a sell here, they will be placing their stop loss above this swing high, only for smart money to come up there, sweep the available liquidity above this swing high and causing price to go in that other direction. So my tip is always look out for inducements when price is approaching a point of interest, like an order block, a supply and demand zone, or a flip zone, or even a sweep zone, right? Any sort of point of interest. Because when price actually approach those zones, that is where so many retail traders, they will be impatient and they will enter too early just for price to come down and sweep the available liquidity before the actual move actually happens. So always wait for liquidity sweep before entering. And remember, if you cannot spot the liquidity, then you are most likely the liquidity. Instead of me yapping, why not I just go onto the charts and show you how it's done, alright? So right now we got GU on a 15-minute time frame. The first thing you want to do is to actually map out your structure. So over here we got a break of structure to the downside, and this tells us that this is that last 15-minute swing high. Okay, so I'll just put this as the 15-minute strong swing high that led to this break of structure. And then over here, we got price pull back a little bit before going down even further. And this could constitute as your internal break of structure. Okay, so when we got a market shift right here where price actually broke past that last internal lower high, this does not signal that price has officially shifted bullish. This just signal that price is potentially turning bullish to facilitate that pullback back to that last swing high before continuing down, going even further and continue creating that lower high, lower low dynamic. So always try to understand what's the objective of price, right? What is price trying to do? So now we have figured out that, okay, price has officially turned bullish to facilitate that pullback. So on the internal structure, we can expect price to create higher highs, higher lows, until price actually break past that last higher low, that last internal higher low, give us the market shift, a shift in structure, then that confirm to us that price is shifting bearish and we can look for our sell position to trade with that swing structure. And then the next step is to actually mark up your point of interest. Okay, so over here, we got our extreme supply zone right here that led to this break of structure. And then there is also another supply zone right here. Okay, there's also another supply zone right here. This is more of an order block, right? But I'll just label this as a supply zone right there. Let me just mark this up right there, make it a little bit more cleaner. Okay, so right now we have our 2 point of interest. We know that price is turning bullish to facilitate that pullback. The objective of price is that it wants to mitigate this, either one of this supply zone, right? Fill up the remaining sell orders before heading back to the downside, right? So in this case, let's just continue to play price forward and just wait for price to mitigate that point of interest. So until price actually does that, we are not doing anything. Okay, cool. You can see price has stepped into our near supply zone. Remember when I told you that inducements tend to form at a point of interest? This is exactly what I mean. At this point of time, just because price has stepped into a supply zone does not mean that price is going to go down straight, okay? What can happen is that it can create inducements, traps, to entice retail traders to enter a sell position early just for price to go up there, sweep the available liquidity before heading back down even further, right? So you don't want to enter too early. You want to enter at the perfect timing. So at this point of time, we are waiting for our inducements. Okay, you can see price is reacting at this supply zone, but we are patient. We are not doing anything whatsoever. Because first of all, there is no inducement. Second of all, we haven't got a shift in structure that tell us that the structure have shifted bearish and right now we're going to continue to go down. Because right now price can continue to go up even further. Okay, so you can see price started shifting bearish and then we are getting a reaction from this zone right here. And what do we have right now? We have a double top, right? So if you look at this, we got a price reacting from the supply zone, pull back, and then goes up there, react from this supply zone again, and then start coming down right here, right? So there is actually a double top, and remember, double top, the 2 tops does not have to be the same height, okay? So you can have one that is higher than the other. It is still counted as a double top. And in this case, there is also another double top right here. You can see like a fractal double top right here on the 5-minute time frame. Okay, so right here we got our inducements, very nice double top right here. This is where most retail traders, they might want to enter for a sell somewhere right around here. And if they do enter for a sell here, guess what? They're going to be placing their stop loss above these highs right here. And in this case, let's look at what happened next. Okay, price went down, they are in profit, they are happy, they are celebrating, you know, they are considering getting that new car right now because, you know, they have made 10K and boom, they just lost, I don't know, their life savings or something, right? Too bad for you. You don't understand liquidity, right? So if you're watching my video, you shouldn't be operating in this way. You should be operating like a professional, all right? So at this point of time, we know that, okay, we got that inducement, we are patient, right? We are not trying to enter for a sell here too early whatsoever. We are waiting for our liquidity to be swept before actually entering for the trade itself. And what do we have right here? We got a very nice liquidity sweep, right? Where price actually go up there, sweep the available liquidity above this swing high right here, above this double top, and then right now we can expect price to actually create like that reaction, right? But in order for this liquidity sweep to be valid, it needs to create a sharp V-shaped reaction just like this. So I'm waiting for that still, right? I'm not entering yet. You can see very sharp V-shaped reaction, right? Very nice. Now at this point of time, we got our liquidity sweep, but that does not allow me to enter for the trade yet, because what can happen is that price can still go up even further because the internal structure is still bullish. So you map out your internal structure, you will see that, okay, this is that last swing high, okay, this is the 15-minute swing high, and then this is that last swing low that we have right here. Okay, so this is actually our 15-minute swing low. So in order for us to confirm a shift in structural, in order for price to turn bearish, price has to break past this last 15-minute swing low, right? And that will tell us that price has officially shifted bearish, right? So at this point of time, we got our liquidity sweep. We are still patient. We are waiting for our market shift right here that confirmed to us, you know, we are, the lower time frame structure is aligned with the higher time frame structure. Then we will start entering for the trade. And there we have it, a very, very beautiful market shift. Ladies and gents, this is your entry signal, right? So at this point of time, you know, I will be mapping out the point of interest that led to this market shift. Okay, so this is a little supply zone, okay, or order block, whatever you like to call it, that led to this market shift. And this is where I want to actually enter for the trade. If you have watched my videos in the past, you will also know that this is actually a flip zone because we are reacting from this supply right here. I mean, this demand zone right here. And if this demand zone were to do its job, price will continue to go up. But in this case, it created a failed reaction right here, right? So this is actually our 15-minute flip zone. And this is where I want to actually look for my entry. Price immediately pull back into the area right there, tap me into the trade. And at this point of time, your stop loss, you can place it above this flip zone, or you can even place it above that liquidity sweep, right? Because once price sweep the available liquidity above this swing high, we know that this high right here is somewhat protected, right? So in that case, you can place your stop loss above this high as well. Okay, so it's really up to you. And for illustration purposes, we're just gonna keep this strategy simple and just gonna target about 3R. Okay, just gonna target 3R just like this. Okay, so obviously I would actually place my stop loss above this flip zone. I wouldn't place it so far up, right? Because I know my shit, alright? So yeah, you can see price pull back, boom. Immediately go into profit. Look at that large amount of imbalance. Okay, within like a few hours, it just dropped into our take profit. As simple as that. This is the power of liquidity. When you can understand liquidity, you're essentially God, right? You're essentially God. Now, this is how I personally trade liquidity sweeps, right? There are some traders out there who might actually enter for a sell somewhere right around here after price sweep liquidity, and in that case, they'll be placing their stop loss above, once again, this protected swing high that swept liquidity, and you could potentially be targeting this area right here, right? And in that case, that might work for you as well, right? So if you want to do that, by all means go ahead. My advice would always be the same, and that is to test out which entry work better for you. For me personally, I need to wait for the market shift to give me further confirmation, right? And I get that multi-time frame alignment before I can actually, you know, let the trade do its thing. But for some of you guys who might be more aggressive, then in that case, you might want to enter straight away after the liquidity sweep. Find out what works for you based on data that you collect after countless of backtesting and forward testing, okay? Okay, now let's look at the next example that we have on EURUSD on a 4-hour time frame, right? So same thing, first things first, go and map out your structural. You will see that this is the last bullish break of structural that tells us that this is actually the last swing low, and then right here, this is that last swing high. So right now, we know that the objective of price is that it's turning bearish to facilitate that pullback to that last swing low before price could potentially create that new higher low and continue creating your higher highs and higher lows to the upside. Okay, so now that you have understood the objective of what price is trying to do, you must mark up your point of interest, which is step 2, right? And you will see that this is actually demand zone right there, a 4-hour demand zone. And then there is also another demand zone right here. It's a tiny one because what happens is that price actually got there. It pulled back on the lower time frame, make a small little pullback, and then it just goes back up, right? But it is still counted as a point of interest, right? So this is actually our demand zone. Okay, so you can see right now price has actually tapped into this near demand zone, right? So when you look at this, there is 2 demand zones. There's the near demand zone and then there's the extreme demand zone. I personally don't like to enter on the near demand zone because when you enter the near demand zone, right, you try to enter for a buy right here and you place your stop loss below this zone, what happens is that price could potentially come down and tap into extreme zone before the real move actually happened. And in that case, if you entered once right here and then right now you enter again after price actually come into this extreme zone, you are prone to being wrong twice, okay? Because what happens is that if this zone fails as well, in that case, you have been wrong 2 times. One time right here and another time right here. But if you just enter the trade at the extreme zone, you might just be wrong once and that's it, right? But obviously this depends on different scenarios in the market, but that's a conversation for another day. But for now, price has stepped into our near demand zone, so we are looking at what price is doing at this near demand zone. So at this point of time, price has actually reacted from this near demand zone that we have right here, right? So let's go down to the 1 hour time frame and see what price is doing, right? And you can see we got that price reacting right here, and we know that we are trying to spot inducements at this point of interest, right? So let's continue to play price and see what price does. Okay, so you can see right here, when price actually reacted from this demand zone, guess what? All the retail traders, or rather most of them, they're going to enter for a buy right here, and they're going to be placing their stop loss below these lows. Now, because what happens is that price is just mitigate from their demand zone or their support level, right? So obviously, price is going to go up now. And then later on, price comes down, sweep the available liquidity up below this low right here, and look at what we have. We got that sharp V-shaped reaction to the upside right there. Okay, so at this point of time, we got a strong low being formed, right? Because prices actually went up there and broke structure. Okay, it broke structure right here. Okay, when a strong low is formed just like this, once again, the retail traders, they're going to be entering for a buy right here, and they will be placing their stop loss below this strong low right here. After all, what could go wrong, right? This is a strong low. Price is not going to go lower than this, right? Price is just going to go up right now. So let's look at what happened next. Dun, dun, dun. Guys, come on, guys. You're better than this. This is what happens when you don't understand liquidity. You are the victim of market manipulation again and again and again, right? So wake up, buddy. So what we have right here was that price is just sweeping the available liquidity above this last high right here, just for price to go down even further. And that is why I don't actually recommend you guys to actually enter on the near zone. Okay, so we got that inducement, that strong low inducement right here. We know that there is available liquidity below these strong lows right here. Okay, so I'll just put that liquidity mark right there. That shows us that there is available liquidity below these strong lows. As you see right here, price has just went down there and the available liquidity below the strong low. And right now we can expect price to actually go up right there and then actually creates that real market shift to the upside. Okay, so at this point of time, if you look at the extreme zone is still unmitigated, right? So there is still a chance that price will come down in the future to mitigate this extreme zone before it actually goes up there and break past that last swing high. Okay, so right now, if you did actually enter for a buy right here, after you got that liquidity sweep below the strong low, you can potentially target like this area right here, or 1 to 3R, right, like what I've mentioned earlier. But let's continue to see what price does. Because what happens is that if you look at it closely, at a high level, you will actually see that there is available liquidity below this strong low as well, right? So this one is kind of harder to spot, but once again, I just want you to time travel back with me a little bit. Okay, so what we have right here was that this was that last break of structure, right, to the downside, which means this is that last low. And then we got price actually breaking past that last low that we have right here. When price break past this last low, we got a market shift right here, and this tells us that this is the new strong low. Okay, this is the strong low that led to this market shift right here. And because it is just a beautiful swing low just like this, there is available liquidity below this swing low. Okay, so yeah, this one is a little bit trickier. Okay, but right now, remember, your extreme zone is unmitigated. So what can potentially happen is that price is going to come down there, sweep the available liquidity from this strong low before the real move actually happens, and take out this swing high right here. Okay, so you can see price came down later on, available liquidity from that strong low. Okay, once again, you must understand the rationale of this. When retail traders, what they will do is that they're going to be entering for a buy right here. Okay, not even retail traders, maybe even a lot of expert traders, they see price actually creating this market shift right here. They'll potentially enter a buy right here after this strong low is created. And that is where they could potentially be target, like maybe right here, or maybe even at this swing high, because they're expecting price to take out this swing high, right? And maybe they're placing their stop loss below this strong low right here. Maybe their entry was like right here, because this is a little bit ridiculous. This is a little bit too late. But let's say they have like some good entry. Let's give them some credit, okay? And in this case, stop loss below this strong low, liquidity right here. They are trying to target this swing high, and then they see price going so near that swing high, then bam, reverse against them and hit their stop loss. Now this is where they are raging. All right, this is where they are angry because they just got stopped out right here. And that is really just price sweeping the available liquidity from this strong low. And then the real move actually happens right there and finally take out that last swing high and move up to the upside.